Now it's live, sir.
Okay. A very good morning to all. Hope you all are good and safe with your family. So continuing with the program schedule, today is the 14th day of the program, and the theme of the today's lecture is post-pandemic challenges and opportunities of monetary policy strategy in India. So, and today for this session, I would like to introduce you all with a well-known academic personality of ISI, and for a brief introduction to the resource person who is going to deliver the lecture today is Professor Chetan Ghate sir. So I welcome Professor Chetan Ghate sir to the refresher course of Ramanujan College, and I'm going to tell you some summary about a brief introduction to Chetan Ghate sir, so that you may be familiar to be more comfortable to connect with him. Professor Chetan Ghate sir is a professor of economics in the Economics and Planning Unit, Indian Statistical Institute, Delhi, and has been teaching in ISI since 2000. He received his PhD in economics from Claremont Graduate University, California, Master in Economics from the Delhi School of Economics, and BA in Economics from Colorado College. His research focuses on macroeconomics, monetary economics, macro development, and the Indian macroeconomy. He has published widely in his field. Recent papers have appeared in studies in nonlinear dynamics and econometrics and economic inquiry. In 2014, he was awarded the Mahalanobis Memorial Gold Medal given to the best research economist in India under the age of 45. Chetan sir has held a variety of visiting faculty positions in India and abroad, and has been closely involved with the Reserve Bank of India in an advisory capacity. He finished a 4-year term as a member of the Monetary Policy Committee of the Reserve Bank of India in October 2020. From 2012 to 2013, he was the Reserve Bank of India Chair Professor in Macroeconomics at ICRIER New Delhi. From February 2013 to September 2016, he was a member of the Technical Advisory Committee for Monetary Policy at the Reserve Bank of India. In September 2013, he served as a member of the expert committee to revise and strengthen the monetary policy framework, which provided the blueprint for the current inflation targeting framework in India. Sir is a member of the Academic Advisory Board of the Reserve Bank of India Academy and serves on the editorial board of the RBI Occasional Paper Series. Chetan Ghate sir is a member of the advisory committee of the National Account System in the Ministry of Statistics and Program Implementation. He is also an external affiliate of the Center for Research in Macroeconomics and Macrofinance at Swansea University, Wales, United Kingdom. After all this, additionally, he likes to read, trek, play jazz guitar, and run long distance in his spare time. So I'm sure this versatile and dynamic personality of Chetan Ghate sir will surely enrich your knowledge and give you a wider thinking platform to go ahead with the academics and research sections. Without wasting the time, I would like to welcome Professor Chetan Ghate sir to deliver his lecture in this session. Please, sir.
Okay, thank you very much, Saurabh. It's very nice of you for that kind introduction. I'm going to focus the bulk, maybe not the bulk, but a large portion of my time just running through some of the challenges of setting monetary policy in a large emerging market economy like India. And then I'm going to use that as a segue into monetary policy challenges in a post-pandemic world, in particular focusing on India and learning a little bit from the US experience on monetary policy. So that's going to be the rough layout. Okay, so, and I'm going to go roughly for an hour. I would like to ask all of you to submit your questions in the chat box. Saurabh will be moderating those questions. I won't take them as I speak, but at the end of about an hour, I will leave about 20 minutes to go through the ones that I can answer to the best of my ability and try and answer all of them then. So we'll leave the answering of questions till after the talk. So First of all, just in terms of overall goals, monetary policy as part of macro policy impacts economic growth, inflation, and financial stability. And the RBI was established in 1935. 1935 to 1950 were the formative years. C.D. Deshmukh was appointed governor in 1943. He served till 1949. Then from 1951 to 1970, you can call this period the development phase. And in this phase, monetary policy was geared towards planned financing. So we had successive 5-year plans starting in 1951, which led to several quantitative control measures while ensuring credit to the preferred sectors. Now, think of the period from 1971 to 1990 was a focus again on credit planning. 20 banks had been nationalized, as you all know, in 1969, pursuing social objectives for nationalized banking. The CRR and SLR, the cash reserve ratio and the statutory liquidity ratio, were prescribed by banks and used to balance government financing and inflationary pressures. Now, within this period between 1970 to 1990, in the 1980s, you see the formal adoption of monetary targeting, right? So you begin to see reserve money being the operational target and broad money M3 being the intermediate target. In April 1998, just to give you a blueprint of the structure of the development of how the Reserve Bank progressed, Dr. Rangarajan switched to a multiple indicator approach for setting monetary policy. So a variety of indicators were taken into account when setting the policy repo rate. And then in the period after the great financial crisis, post 2008 and 2009, the multiple indicator approach began to get questioned, and high inflation continued after the great financial crisis period. The Urjit Patel Committee was formed in September 2013 under Governor Rajan. In February 2015, by the way, that report was submitted in January of 2014. So I argue that de facto adoption of inflation targeting actually started from April 2014, so in that financial year. Even though the government of India signing the monetary policy framework agreement, adopting flexible inflation targeting happened in February 2015. In 2016, the RBI Act was amended. The amendment meant that now the MPC could set the policy rate. Before the governor was setting the policy rates, the act had to be amended. And currently, the monetary policy framework that we have in place is one of flexible inflation targeting. And in end of March 2021, April 1st, 2021, we have now seen an extension of flexible inflation targeting for another 5 years. Now, something on liquidity management, because this is going to be crucial to how we deal with stabilizing the economy in the current post-pandemic policy stimulus. In April 1999, the RBI introduced the LAF framework. Okay, this is the liquidity management framework of the Reserve Bank of India to manage liquidity through the repo via liquidity injections and the reverse repo through liquidity absorption operations. And in May 2011, the Reserve Bank of India introduced a new operating procedure where the weighted average call rate, the overnight rate, money market rate, became the operating target of monetary policy. Now, one of the challenges, and this is going to feed once again into the discussion on post-pandemic monetary policy challenges, is understanding why monetary policy transmission in India is weak and what are the channels of monetary policy transmission. So we have to get an understanding of when the central bank sets the policy rate, do they work or not, and why, and what are the ways through which what are these channels? Now, in the last 3 decades, the Reserve Bank has tried to improve monetary transmission, but it hasn't achieved this to the extent that it is wanted. So the first problem that we all know is that the transmission of the repo rate to changes in lending rates tends to be slow, right? So when the transmission from the policy rate to bank lending rates and deposit rates tends to be slow, then this blunts the ability of monetary policy to affect the economy when you have an economic slowdown. Okay? So that's one issue, is that when you want monetary policy to be nimble, when you want to stimulate aggregate demand, the fact that transmission doesn't work seamlessly hinders the ability of monetary policy in India to blunt or to mitigate the effect of a sharp shock. The second issue is, and this is, by the way, an exciting area for scholars to be in, is to look at monetary policies and economies which have a large informal sector and try and understand how the presence of an informal sector is important for a monetary policy transmission, and and the mechanisms through which the presence of a large informal sector hinders monetary policy transmission. And I have a paper last year in Economic Inquiry in 2020, which tries to understand this particular area. So this is a nice research area for Indian scholars and scholars in developing countries to contribute to. It's kind of looking at informal sector models with informal sectors and understanding the mechanisms through which monetary policy is challenged because of the presence of a large informal sector. Now, we know that, so those are two things. First, transmission from the policy rate to, well, I mean, the transmission to money market rates, which is the first leg of monetary policy transmission, tends to be seamless up to most financial assets up to a duration of about 2 years. And then the second leg of monetary transmission is typically understood to be from the wholesale money market to bank lending and deposit rates, right? And the first leg tends to operate well. The second leg is the problematical leg in terms of understanding monetary policy transmission. Now, we know that, let me talk a little bit about the channels of monetary transmission. RBI operates monetary policy through the interest rate to finally impact inflation and growth. And why inflation and growth? Because the RBI Act, the amended RBI Act of 2016 says we must set monetary policy keeping, of course, price stability in mind, but also keeping the objective of growth in mind. So this is called a dual mandate, and almost all central banks set monetary policy having such a mandate. Now, some central banks, like the Thai Central Bank, for instance, has financial stability also in its mandate. In the literature, one typically thinks that macroprudential regulation is probably the appropriate tool to think about financial stability concerns. And monetary policy should solely devote itself to worrying about the inflation output trade-off. So there's a clear dichotomy between what the role monetary policy has and what role prudential regulation has in impacting financial stability. And that role also therefore dictates what enters into the mandate. And the RBI's amended act says the mandate means that we should look at price stability, and it defines price stability to be 4 plus minus 2% inflation, keeping in mind the objective of growth. Now, the interest rate, when the policy rate is set, it's going to transmit through the yield curve, right? It's going to translate through longer duration financial assets, money market financial assets. And you can understand the problem of transmission, one being where even though the overnight rate that the central bank, the policy repo rate that the central bank sets, affects the short run of the yield curve, the problem of transmission means that transmission does not happen along the yield curve. Okay, so that's important to understand. Now, what does it mean? How does this work? So also just remember that the Reserve Bank of India is also the debt manager to the government of India, and it's also, you know, entrusted with lots of other responsibilities. It's in charge of the payment system. It's the regulator of the banking sector. SEBI is the regulator of the capital market. So the RBI is a full-service central bank. Now, the interest rate, and this is important, is a key price that impacts many sectors. And the main channel through which we typically at least teach undergraduates that how monetary policy works is we say, look, you know, in an ISLM framework in the short run where prices are fixed and therefore nominal interest rates are the same, right? Because there's no inflation because prices are fixed. If the central bank raises the interest rate, the nominal interest rate, because prices are fixed, there's no inflation, that also raises the real rate. And then from the IS curve, all the interest rate sensitive components of spending fall, And by the way, that does not just mean investment. There are elements of consumption demand, such as consumption durables, which are interest rate sensitive. When you go out to buy a car, when you go out to buy a washing machine, and so on, you may typically finance them. And broad interest rate changes in the economy should also be reflected in the interest rates for these consumption items. So I'm not talking about the interest rate channel only happening in terms of affecting investment through the cost of capital. I'm also talking about it happening through interest rate sensitive components of aggregate demand. But the channel is this, that if interest rates rise because you want to cool the economy down, the real interest rate rises, and therefore investment in the interest rate sensitive components of consumption spending fall, and therefore aggregate demand falls, and that pulls down output and that pulls down activity, and therefore that cools the economy down. But what you have to understand is that that's not the only effect of the policy rate change. Okay, if you, for instance, want to cool the economy down by raising the real interest rate, you know that if you raise the real interest rate, Indian financial assets are more attractive compared to foreign financial assets, and that's going to lead to capital flowing in. Once capital flows in, that's going to lead to a currency appreciating, and that's going to lead to net exports falling. So the second effect of this interest rate hike is not only on curbing demand for interest rate sensitive items, but it is also affecting net exports through a currency appreciation via capital flows coming in. Okay? And when the interest rate rises, and this is where the Reserve Bank of India faces attention almost on a daily basis, because it's the debt manager to the government of India. So right now, as you all know, in the current COVID crisis, a lot of debt has been accumulated because there's a large deficit, right? Tax revenues reflect economic activity, and economic activity has slumped, so tax revenues have fallen. But the need to stimulate the economy is strong. We need social insurance payments to the poor. We need to keep firms going, and so on. That's led to a massive increase in deficits and therefore debt. But the RBI, therefore, with a higher interest rate, suppose it's trying to, if it raises the interest rate, it also raises the real cost of borrowing for the government of India. So it faces this tension. One action actually feeds into lots of other actions, and if it raises interest rate, that raises the cost of borrowing, and that can also be a drag on growth. First thing, so the MPC has to take all of these different channels into account when it is setting the interest rate. The second thing is that monetary policy can operate through conventional channels. Okay, so it can affect the short-term policy rate, and as I said, that if transmission was good, would transmit throughout the yield curve, right? Or lots of advanced economies, and even India now, have started adopting unconventional monetary policy. This takes the form of forward guidance. So if you look at the recent MPC resolution, there was a shift from time-based forward guidance to state-based forward guidance. In other words, you say, we are going to keep the stance as accommodative until the economy revives. And that assures financial markets that the central bank is not going to increase the policy rate until it sees that the economy is picking up. It may enact long LSAPs, LTROs, TLTROs, long-term refinancing operations, targeted long-term refinancing operations, and so on. Advanced economies, for instance, have enacted a negative interest rate policy, right? So they've faced a zero lower bound, and they're basically disincentivizing banks from parking money with the central bank. In fact, in a negative interest rate policy regime, banks have to pay the central bank something to do that, because they want to incentivize banks to lend money to the economy. So they want to disincentivize banks to put money into. In our case, it would be like a reverse repo window, where if you keep the reverse repo window low, then you'd think banks would not want to park it there; they would want to lend it out. Okay, so you should appreciate that also. Third, so that's one thing. That's also part of the toolkit of the central bank. But the effectiveness of monetary policy also depends on the overall policy environment in which the economy functions. So it depends on how strong your banking system is, and how strong your financial markets are. And since the 1990s, the liberalization of financial markets has proceeded in a gradual pace, and I'll have a lot to say about this. One form that this has taken in the banking space is that we have the entrance of new banks. So in India, in the banking space, we have scheduled commercial banks. Um, uh, um, they're scheduled because they appear on a schedule of the RBI Act 1934. I can't exactly remember off the top of my head how many scheduled commercial banks there are, but they're probably 100 plus minus something in that range. Then amongst these, there are some that are universal banks. There are amongst these, there are public sector banks, there are private banks, there are foreign banks, there are right, and then that's kind of the banking space, and then you have cooperative banks. If I remember correctly, the cooperative banks are not defined in the RBI Act of 1934, but they come under the Cooperative Societies Act, which is a separate act. But the regulatory powers of the Reserve Bank of India is defined by the RBI Act of 1934. It's also defined. This is very important, and this is something I began to appreciate more and more as a researcher, is that what the powers are defined by the Act. So you have a Companies Act of 2013, you have the RBI Act of 1934, then you have a Bank Nationalization Act of I think 1949, plus its more recent variants. But these give these define the powers of regulation by the Reserve Bank of India, for instance, over public sector banks and private sector banks. And then then you have different types of banks. You have universal banks, you have small finance banks, you have payment banks, you have rural banks, you have cooperative banks. So you have it's a large space. And then there's a non-banking financial company, NBFCs, which are also responsible for lending to last mile consumers. So before we talk about the problem with the NPAs, it's important to understand, since this is a talk about post-pandemic challenges, one obvious challenge is going to be the health of the banking system through NPAs. If you all remember, in 2015, the need to deal with the NPA problem in the banking system picked up under Governor Rajan and Governor Patel. So there was an asset quality review in 2015. And then I think shortly thereafter, banks were given 6 quarters to come up clean and declare their NPAs. So that recognition led to a discrete jump in the stock of NPAs in the banking system. And then remember, there was demonetization. And under demonetization, what happened was that banks were flush with deposits. And those deposits were then because after the asset quality review, something of the order of 10 or 11 banks, some large banks, were put under prompt corrective action. They found it difficult to lend, and therefore the lending ended up happening to the non-banking financial companies who were lending out. And then, if you remember, then in 2018, IL&FS defaulted, and that was coming because in 2018 you also had 2 subsidiaries. IL&FS had a very, very complicated structure, right? So under it had a bunch of subsidiaries, but I think ITNL and IFIN, I think, also defaulted earlier on in the year. And then there were problems again with Yes Bank, with Dewan Housing Financial Company, and so on, with ICICI, and all of these problems were some combination related to inadequate equity, very high debt equity ratios. So for instance, some NBFCs are core investment companies, so the Reserve Bank of India just does light touch regulation on them. Some of it was just misgovernance, some of it was fraud, and it led to a problem where credit markets started kind of slowing down. Now, there's a little bit of a debate about whether this was a Lehman moment or not, whether there was contagion in all the NBFCs or not. You could argue that it was confined to some few large NBFCs, but the other NBFCs were okay, and this is a debate that is going on. But one of the post-pandemic challenges is going to be how to deal with the stock of NPAs in the banking system with the shock. Okay, and then how do you deal with it? How do you deal with it? Should you consolidate banks? Should you recapitalize banks? Um, is governance, corporate governance, the problem? How do you appoint members to the board of large banks? So should we set up a bad bank? What are the costs and benefits of setting up asset reconstruction companies? Um, is the IBC tooled to deal with the quantum of bad loans that we see at the moment? What are the problems with the IBC and so on? So these are all, and we recapitalize banks, public sector banks, but we don't recapitalize private sector banks. If we didn't recapitalize public sector banks, would they fail? Probably. So these are all how strong should the regulatory and supervisory system be? If it was too strong, would it choke off growth? Would it, on the one hand, you want to encourage credit offtake, but on the other hand, a very strong approach to regulation and supervision may curtail credit offtake. So this is a big area that central banks have to worry about, and certainly is a important area that the RBI has to worry about. Before I talk about this in a little more detail, let me go back to, again, the first area which is important, which is monetary policy transmission. So as I said, transmission has two legs. It's important to understand this. There's the transmission from policy rates to the money market rate, right, which is instantaneous. And then you have transmission from money market rates to bank lending rates. And the transmission is swift and fairly strong. As I said before, in financial asset segments to about 2 years in money markets, and instantaneous. But the problem in India is with the second leg. Okay, and the second leg is important because this is a bank-based financial system. It's a bank-denominated financial system. And the main reason is that most lending by banks in India is contracted at floating rates, right? While most deposits are essentially contracted at fixed rates. And this leads to an asymmetry, right? That's one set of issues. The second set of issues is the facing of competition by banks from mutual funds, either through tax treatment, how you account for returns, and banks feel pressure and competition from deposits, what is now called the financialization of savings. So households now don't only put money into bank deposits, but they put them into mutual funds. But also small savings schemes give you guaranteed returns that are high, and banks say, look, if we're to compete with deposits, because it's largely deposit-based lending, we have to keep our rates at least matching small savings schemes. So that may impact transmission. Although in the same paper that I'm talking about in Economic Inquiry in 2020, we show that the small savings rates are not the problem. That's not what is hindering transmission. What is really hindering transmission in India is the size of the informal sector. You get much more you get better transmission if more people were engaged with the formal banking system. Now, some of the steps that the Reserve Bank has taken to improve transmission is a shift to external benchmarking in 2019. And here, what this means that all scheduled commercial banks had to link their floating rates, right? Legacy loans were untouched, but the floating rates had to be shifted to an external benchmark. And the external benchmark is something that is published by the Financial Benchmarks of India Private Limited, FPIL. So it could be RBI's repo rate, it could be the Government of India 3 to 6 month T-bill rate, or any other benchmark interest rate published by FPIL. And this was a direct contrast to the previous regime. And I don't want to talk too much about this because you probably know this, but the previous regime was one where banks were pricing loans based on the marginal cost of lending rate. And there was so much ambiguity in this is that banks could essentially game it and charge whatever rates that you wanted. It was formula based, but there was some discretion in that formula, which allowed banks to basically figure out that the marginal cost of funds was high, even if the repo rate was falling. And under the external benchmark system, which was supported and pushed by the current governor, the improvement in transmission has been stronger. Okay, so that's good. Now, the other instruments of monetary policy are the reverse repo rate, the cash reserve ratio, and the statutory liquidity ratio. You know that. And India is now currently a flexible inflation targeter. It mandates, specifies price stability, keeping in mind the objective of growth. And in India, this is a very kind of active policy debate. People have strong views about whether India should be um, an inflation targeter, and some criticisms made also pertain to the current growth hit that the Indian economy will get, is that, if you're going to be thinking about inflation too much, you may not be able to adjust the policy rate downwards to deal with the extent of the shock that we're facing right now. The other criticism is that, look, food is something that is essentially supply driven, and monetary policy doesn't affect the price of food. So once again, when you hear this kind of argument put forward, this is where research can really help. Is research should address these kinds of problems. So in recent work, if you look at, and I think you could get this talk on YouTube, it's an eGrow Foundation lecture that I gave, I think, on March 26th. Please look at it, and that shows that it is possible that the supply side shocks in food are actually the argument for responding to inflationary pressures coming from the supply side is that they get generalized and have second round effects. We know that. But the mechanism through which this happens is not clearly understood, right? We have a hazy sense of this, and the argument always is that, look, it's a food price shock, so that's going to creep in, it's going to get generalized. But we don't write formal models down trying to understand this. So please look at this eGrow Foundation talk, where we have a very different take on how food inflation, first of all, creeps through the rest of the economy, and number two, how monetary policy should respond to it. And this is a model where there are rich people, there are poor people, there are two sectors, and there's government policy in it. Okay, so this is what is, and this is my kind of second research spin. The first research spin that I'm giving you, since many of you are scholars and teachers, and some of you are probably doing your PhD and looking around for ideas, is that as a country, we can contribute to modern macro research by thinking about models with informality, number one. Number two, we can also make a contribution by looking at multi-sector DSG models, okay, where the sectors either correspond to, manufacturing, services, agriculture, or modern, non-modern, or informal, non-informal. But what's important in research and monetary policy in large EMEs is also thinking about multi-sector frameworks. And so in this eGrow Foundation lecture, what I'm trying to get across is that this is a model where there are multiple sectors, and there are also different types of agents. So how monetary policy affects the poor and rich are going to be very different. And it's that aggregate response adding up from all of them that needs to be taken into account. Okay, now a quick review of the four channels. So I talked about the interest rate channel. The interest rate channel works by the central bank affecting the interest rate sensitive sectors of aggregate demand. Consumption, for instance, savings, which is the flip side of consumption and investment. But all of these affect the economy with a lag, right? And I'm going to say is that this channel tends to be in a lot of modern research. And again, I'll throw if you Google this, Google heterogeneous agent new Keynesian models. This is really the frontier of monetary policy right now, where there's a lot of heterogeneity built in, because now you can think of households having access to liquid assets, illiquid assets, incomplete markets. So the direction is now moving into a much more richer structure. But we typically understand that this channel to be weak, and it tends to be again affected by what capital flows come in and go out through the change in the exchange rate. Now, the second channel is called the credit channel, and the credit channel operates through the ability of banks to provide loans. And the credit channel works through the central bank, for instance, raising the policy repo rate, right? And because that means that it has to, take out reserves from the banking system, the decline in reserves means that the demand by banks for reservable deposits have to fall. And if the demand for reservable deposits by banks fall, and if the Modigliani-Miller theorem breaks down, in other words, if banks cannot compensate by, let's say, issuing commercial paper and then lending out, because there's some friction between the decline in lending that comes from lower deposits and increasing lending from some other route, there's a friction there. The Modigliani-Miller theorem would say, look, there's no friction, so they can do that. So in theory, even though the central bank has hiked the interest rate, even though the demand for reservable deposits has fallen, they can actually switch to a non-reservable deposit base for lending out. So they could issue commercial paper and take the proceeds to lend out. But suppose that there's a friction there. Suppose there's some friction, and that could be either an insurance premium coming from some problem in asymmetric information, for instance. Then what that means is the lower deposit base of banks leads to lower lending by the economy, and therefore credit supply falls. And that's the bank lending channel. It assumes a breakdown of the Modigliani-Miller theorem. Okay. There's also in the credit channel heading a bank lending channel, which I just described, but there's also a balance sheet channel, which relates the ability of banks to finance projects through a financial accelerator and an external finance premium. And that kicks in, which makes collateral values fall, which makes the bank's net worth falls, and therefore they're able to borrow at higher and higher rates. Their demand for investment falls, and therefore that leads to a reduction in output and investment. Okay, so that's the second channel. That's the bank credit channel, and this is the predominant channel in the Indian system. And again, this is a very nice area to work in. The third channel is the exchange rate channel. In the exchange rate channel, it works through expenditure switching. So if the central bank, for instance, raises the nominal interest rate, that's going to lead to a rise in the appreciation of the currency. Foreign goods are going to become cheaper. Domestic goods are going to become more expensive, and that's going to lead to a demand for domestic goods falling, and that's going to lead to a decline in net exports. Okay, so that's the third channel. The fourth channel is an asset price channel. The asset price channel works in the following way: that if you have a higher interest rate, then that leads to a dampening in equity prices. You should realize that in India, not many people hold equity, so this channel is going to be weak. Sometimes this channel is also talked about in terms of Tobin Q. And if you want to, the story is that if the central bank, for instance, tightens money supply, that means that there is less money floating around in the economy. If there's less money floating around in the economy, then people spend less on goods and services, but they also spend less on financial assets, and that reduces the price of equity. And if that reduces the price of equity, then Tobin's Q falls. Tobin's Q is basically the market cap divided by the replacement cost of capital. So if the price of equity falls, the market cap falls, and therefore, relative to the replacement cost of capital, it becomes expensive for firms to issue equity to finance investment. So either you can think of the asset price channel directly through a wealth effect. The wealth effect says, I own stocks. If interest rates have gone up, my equity prices have gone down, and then my stock portfolio is worth less. And that's going to feed into consumption and investment changes. They're going to fall. Or you can think about it in terms of Tobin's Q. If the quantum of money is less, then people spend less on equity, they buy less stocks. If they buy less stocks, that leads to lower market cap because price of equity falls. That reduces Tobin's Q, and that reduces investment. The evidence for Tobin's Q in India is almost negligible. It's not weak, but this is a channel that is expounded quite strongly in the context of advanced economy. So 4 channels. Let me summarize. An interest rate channel. There's a credit channel, which is divided between a lending channel, a bank lending channel, and a balance sheet channel. Okay, the bank lending channel is predicated on the Modigliani-Miller theorem breaking down. The balance sheet channel revolves around the story of financial accelerators and external finance premiums. Then you have an exchange rate channel, which deals with expenditure switching. Okay, it's the shifting of the demand for goods by domestic residents away from foreign goods to domestic goods. And then you have an asset price channel, which operates through, wealth effects. Again, the wealth effect story can be seen a little more broadly. You can think of your wealth effects being given by financial wealth plus human capital. Your financial wealth goes down, so your consumption is going to go down. So think of being, the permanent income hypothesis. So all four channels are simultaneously operative, and one of the challenges in the MPC was to quantify these channels and then figure out what's happening to the overall level of output and inflation via these channels. Okay, now let's go back to the banking system, and let me make some broad comments, and then I'll get to the COVID discussion. So it is true that that there is some hindrance by the quantum and resolution of NPAs in the banking system. It's again an interesting area of debate when this started happening. One view is that in our high growth years, when we had high economic growth, high credit growth, high savings and investment growth, and a lot of these loans were given by public sector banks to 7 or 8 sectors: textiles, let me see if I remember this correctly, roads, airports, power, iron and steel, and mining. I think those were the sectors. So you can see by the names of them that these are largely infrastructure sectors. And some of these sectors were kind of at the forefront of lending in the financial crisis to pick up aggregate demand. Okay, so these were sectors that began to, and then there was a massive shock, and then there was a strong stimulus. But one view is that the NPA problem started around there. There were, I think, so the other thing is comparing the quantum of NPAs to the size of NPAs in the banking system relative to advances, right? And a third issue is, should you just deal with it and kind of be quiet about it, or should you be open about it, declare it, have asset quality reviews so that the public knows, so that the financial system knows where the non-performing assets are? And I think the view there is that one should be transparent, and it's a good thing to be transparent and open about it. But as a result of this, so this is one debate which is a good area of research to be in, is to try and pinpoint, when the problem started happening. Now banks have either been, many banks have failed, they've been recapitalized, they've been consolidated, or in a failing position, and there's also this issue of fear psychosis in banks. That so if you look at what was it? Was it IDBI? I think in the case of the Vijay Mallya case, or whether it was, so the role that investigative agencies have in, arresting bank managers and so on leads to a fear psychosis, which wants them, bank managers to take a step back. So that's one problem. The second problem is that we have, so the corporate bond market, for instance, extends roughly 35 lakh crores in loans at the moment, and the bank credit is about 1 lakh crores. So that's one plus 35 lakhs, or 1.05 lakh crores plus 35 lakh crores, 35,000 crores is roughly 1.4 lakh crores, and we're a 2 lakh crore economy. So 140 lakh crores divided by 200 lakh crores is roughly 70% of GDP. So one issue is, is this kind of credit offtake from the corporate bond market to and the banking sector enough to sustain 8% growth, and it may not be. The third thing I want to say, and this is going to get aggravated in the pandemic period, is we still have forbearances. We have forbearances over SME mudra loans. These NPAs tend to be ignored. It's difficult for us to recognize, the truth in this. And the fourth set of issues here, and this is going to be crucial in the post-pandemic period, is IBC was a good reform, but it may not. I mean, it may, and its predecessors in the early 2000s was that there were debt recovery tribunals, and then there was Sarfezi to 2002. But the IBC may not be geared towards handling the level of bad loans that we have in the system. It's just that the quantum of loans is too large. And the fact that the IBC has teething issues makes the challenge of solving the banking loan problems worse. And this is going to be a problem accentuated in the post-COVID period. You see, so this is one set of challenges in the pandemic period. How is the NPA quantum going to aggravate financial sector health, but also monetary policy effectiveness in the post-pandemic period? The second challenge is, where is growth going to come from? Prior to the GFC, trade growth was roughly 2 times world GDP growth. Post GFC, trade growth has been roughly 1 times GDP growth, world GDP growth. And now with COVID, post GFC by I mean post 2007-9 to COVID, March 2020. So trade is now becoming less important in driving global growth. With COVID, lots of countries, we have too, Atmanirbhar and PLIs and so on, have gone inward. We've been focusing on strengthening our own domestic supply chains rather than finding ourselves to be dependent on the rest of the world for inputs to produce, let's say, medical equipment or anything else. So that thrust is going to get accentuated in a post-COVID world. And that worries me, because I then ask, where's the growth going to come from? If it's not going to come from trade, and manufacturing's level of GDP is roughly stuck at 15% of GDP. We want to get it up to 25% of GDP. But if trade is not going to be the engine of growth, how is manufacturing going to grow? So the third trend is automation. Automation is going to reduce the demand for labor. So where is the engine of growth going to come from? And the answer seems to be some form of service sector predominance. But here's the challenge there, that with the retreat of globalization, and many political, again, this goes back to our own Atmanirbhar kind of policy. Look, for services to work, you need scale, right? Now, how do small countries generate scale for services? I mean, if they don't have a large market, where are they going to get economies of scale? So in some senses, if service sector growth is going to require large markets, but if every country is turning inwards because either they want to shore up their domestic supply chains or they are, taking a retreat from globalization, that means that the scale to generate a robust service sector growth also gets mitigated. So this is going to be another problem in the post-COVID world, is where is the engine of growth going to come from? Fourth, what about the role of non-banking financial companies? So one story given is that after the renewed vigor with which banking sector NPAs began to be recognized under Governor Rajan and Governor Patel, so there was a February 12, 2018 circular which defined when banks should declare their NPAs and so on. And then many banks were put onto prompt corrective action. They could not lend. So the way they could, lend was through NBFCs, and 50% of bank credit. I mean, NBFCs borrow from mutual funds, but they also borrow from banks. Uh, uh, um, so the NBFCs, one view of the story that is put forward is that the NBFCs post demonetization were benefiting from this huge liquidity rush. One, because deposits in the financial system were large, so banks were able to lend. But number two, the banks, after the asset quality review, were put under prompt corrective action. So the way for them to lend was essentially through non-banking financial companies. Um, and then in 2018, if you remember, we hiked rates in June and August, and in October we shifted our stance to calibrated tightening. And then banks and non-banking financial companies in particular were stuck because these are companies that have large asset liability mismatches, right? So they're lending long, but they're issuing commercial paper, let's say at 90-day maturities, and then in 90 days they have to actually pay back the interest and principal on that commercial paper. But if you're actually loaning long, and you know that infrastructure projects have large gestation periods, that money is not coming in, you are very sensitive to an interest rate hike by the MPC. So it is that dynamic that led to kind of a need to and then apart from all the ILFNS and then Yes Bank and then DHFL and then the problems in governance with ICICI Bank led to a kind of a fear culture, and the strong supervisory kind of overreach of the authorities led to a fear psychosis developing in banks. So there's a whole set of issues here about how you should regulate NBFCs, core investment companies. Remember, structurally, we started with development finance institutions, but let's say, even ICICI and I think IDBI both started as development finance institutions, but then they opened up retail banks and they reverse merged. Actually, the DFIs reverse merged back into the banks and they essentially became retail banks. So another set of issues is, what is the role of development finance institutions? Who should capitalize them? Should they be involved in project lending, and banks should be primarily involved in working capital loans, or should be banks involved in project lending and working capital loans? Like the Delhi Noida Toll Bridge Company, which I think ILNFS got involved first in 1992 and it took off in 1998, was the first true public-private partnership, right? That was a public-private partnership, and as you know, ILNFS had defaulted on its debt because of its very complicated structure. So it's it's an area where regulation and supervision needs to be thought through. I'm raising questions here, and I will leave it for you to think about the answers. Okay, now in COVID, what has changed in the banking space, and then I'll get to macro policy. I have 7 minutes, and there's some interesting observations I want to make. One way to deal with the COVID thing is a crisis is that these days you have a lot of app-only banks. You have digital banks. Bill Gates, for instance, has famously known to ask, we need banking, but do we need banks? Technology can do lots of things. It can give you transparency, it can give you traceability, but you should also understand that a lot of these companies like Amazon and so on, or big tech, are also data focused companies. They know a lot about you, actually, more than you know about yourself, probably. And so there are issues here of information and so on, as you keep reading about in the press. So as I said before, there are going to be trends in the global economy that are going to get accentuated in a post-COVID economy. Globalization is in retreat. Where is the source of growth going to come from? The NBA problem. And then the fourth thing is that even prior to COVID, we saw several quarters of declining growth from about 1819 to 1920. And now if you have a big NPA crisis on top of this declining growth because of the COVID crisis, uh, that makes it the situation less optimistic for a robust rebound. And then the fifth challenge is going to be um, uh, if the fiscal deficit is going to be large. Last year it was something of the order of 9.5% of GDP. This year it's projected to be about 6.5% of GDP, but that's just the central deficit. So once you begin to combine the states, and if you're looking at something to the order of 13 to 15% of GDP, that's a very large quantum of money to be borrowed, and for the RBI to do that, and that has implications for debt, for inflation, for interest rate solvency. So another project that I've been doing, and I wrote 2 articles in the Business Standard and 1 in Mint. Please look at them, where we do a security level analysis of public debt in India, and we show that while R is less than G in this debate about should you worry about debt interest payments versus the debt to GDP ratio. In the West, a lot of scholars argue that the debt GDP ratio may be high, but debt service interest payments to GDP are low. So go ahead and borrow and finance a stimulus, a big stimulus, and you won't need to worry about it because you're going to get growth out of it that's going to pay for that interest payment. But we argue that should not be the case for a large emerging market economy like India, because the debt interest payment to GDP is somewhat to the order of 4% of GDP. If you take items both on the consolidated fund and on the contingent liabilities or the public account. But if you just take it on the consolidated fund, I think it is 1.5% of GDP. That's a lot of money, right, to be putting away just on interest payments. So that's a fourth challenge. Okay, now what can we learn? I have 3 more minutes. I'll try and wrap up in 5 minutes. What can we learn from the stimulus response of the United States, for instance? And what is the difference between a regular vanilla recession and a pandemic recession? Okay, so let's think of the current recession as a pandemic recession. So note that what do we see largely because of COVID? The pandemic has damaged the service sector. Okay, it's not damaged the work from home sectors that much. Finance, technology, these are people who can work from home. And at least in the West, while it has damaged the service sector, which are in-person services, restaurants, things like that, it's also not damaged the interest rate sensitive sector that much. So monetary policy has some bite. So in the United States, for instance, the Fed made some moves to strengthening housing, capital, investments, consumer durables, trade, and so on. And these are all areas that are sensitive to interest rates, and therefore these are all areas that are leading the recovery. And I said that the interest rate channel is weak in India because the transmission from banks to the rest of the economy doesn't happen, right? So that kick that the West is getting through the higher sensitivity of interest rates to demand in those sectors that are leading the recovery are somewhat missing here. Now, second thing, all stimuli, I think you have to worry about moral hazard. I mean, should the Fed intervene first in the great financial crisis in 07, 09, and then in COVID in 2021? And if you're going to intervene regularly, then the financial system, banks or financial intermediaries may think that any forthcoming shock is going to be mitigated, and therefore we can, take on inordinate risks. So there's a problem of moral hazard. Third challenge. What should you do? Should you go early and big? Should you cut rates large and move early? Or should you go late and small and gradually reduce? And in the West, they've gone early and big, but there's also discussions about how the US reached the zero lower bound as a result of that strategy much faster. And in India, we cut the repo rate by 70 bips. We also cut the reverse repo rate, which would have disincentivized banks to park their funds in the Reserve Bank, and we wanted them to lend it out. I argued at that time that we were gravitating to a floor system of liquidity management rather than a corridor system, and effectively the reverse repo rate had become the policy rate. Number four, how do you think about COVID in terms of shocks? It clearly is a demand shock, right? In fact, it is primarily a demand shock, right? All of us are staying at home. We're not going out because we're scared we're going to get infected, right? But shops are shutting down too. Restaurants are shutting down too. So from the supply side, there is no activity. So it is also a supply side shock. So it's not to be seen as just an aggregate demand shock or just an aggregate supply shock. It is a aggregate demand collapse, or you can think of it as also as an aggregate supply collapse. So there's an aggregate demand collapse because we're demanding less, but because things are shutting down, there's an aggregate supply collapse, which is also further feeding into an aggregate demand collapse. Okay. Now, and that creates a large output gap. So how have governments around the world tried to deal with this? Well, there's a lot of variation in the response that countries have had in dealing with COVID. So if you compare the fiscal expansion in 09, 10, in the great financial crisis, for instance, it was about 1.5% of GDP on average across a lot of countries. And in the pandemic, it's been about 5% of GDP across countries. So it's a much bigger intervention. And in the United States, for instance, it's been 20 to 25%, because these are richer countries and they're able to stimulate more. Going back to my earlier question, how is a pandemic recession different from other recessions? Well, in a typical recession, you want to get demand back to full employment, right? But in a pandemic, remember, you have this additional problem that the virus itself thrives on economic activity, like we're seeing now. We had opened up too soon, and we were very casual about everything, and life went on as if things were back to normal, and it's just spread. The virus itself thrives on economic activity. So the question then becomes for a policymaker is that you may not want to prevent, or another way to put it is that you want to increase demand, but you also want to increase it safely. And what is driving the safe level of demand is the course of the virus itself. So it's the trajectory of the virus. It's also the extent of vaccination, the amount of herd immunity. So I think if the strategy is to, even though there's a big collapse, the strategy is to prevent all falls in output or employment. I think one has to be sensitive and careful that while reviving the economy, the virus is going to thrive on economic activity. There's an interesting discussion now about at what point does an economy pick off? Do you need herd immunity of 70, 75%? The China-Taiwan case shows that even at 50% vaccination, I think economic activity, because you can either curtail, you can have strict enforcement of, norms, COVID protocol norms, the hand washing, safety, social distancing and all, or you can have vaccination and vaccination. So all these have implications when you stimulate the economy. Next, the effects of the pandemic are highly unequal. Okay, there are going to be some people like me and you who can work from home remotely, right? We can conduct business more or less like we are, but some cannot. So the inequality is going to be much higher in a pandemic recession. So what kind of fiscal policy should you do? if you're faced with a general recession, and a recession is typically defined as 2 successive quarters of negative GDP growth. In India, we have this crazy discussion about a technical recession or a non-technical. Forget about what a technical recession means. It's just 2 successive quarters of negative GDP growth means a recession. Okay? Until now, we hadn't, typically the recession we see is a growth recession, right? Growth falls for 2 quarters relative to 6-7%. So it's kind of a growth recession. But this is actually a recession in the sense first quarter 2021 was minus 25%. Second quarter was minus 7%, I think. So it's 2 successive quarters of negative GDP. Now, how do you deal with this? In a general aggregate demand stimulus, you would think, enact expansionary fiscal policy, do a big infrastructure push, provided you have the fiscal space. The challenge in India is that we don't have the fiscal space, right? Now, how does that work? Well, if you do a big infrastructure push, let's say that means construction workers will start, building things. They will get wages. They will go to restaurants. They will spend. Waiters will get money. They will spend, and you get this multiplier kicking in, right? But in a pandemic recession, certain parts of the economy cannot be open, like restaurants can't be open, malls cannot be open unless there are safeguards, right? So the aggregate demand stimulus that you enact doesn't flow to the workers who are badly affected. Okay. And so the argument for a fiscal stimulus should be one where you cater it to more a social insurance type fiscal stimulus, which is given to the needy or worst affected members of society. The migrants, for instance, the poor, maybe the gig economy, because these are the interaction between the virtual economy and the real economy. They are the ones you order online, but they are on their motorbikes coming to your house to deliver the food, right? So it should take the form of a large social insurance push to the people who are worse, who are the worst affected. And alongside, I think it's important to deal with the underlying virus itself, because if you don't deal with the underlying virus, this is going to be the limitation on where the economy will go, right? It's going to determine your growth trajectory. So, if you do it haphazardly, if you don't have the checks and balances in place, the economy will revive. But this is what the US saw last March. It was an election year. There was a little bit of a rush to open things up. And as a consequence, the virus went out of control. I've already talked about the challenges coming from global growth. And finally, I'll end with, what's the silver lining? Well, has something, despite how horrible this has been, from a macro standpoint, what is the positive here? One thing in our sector, higher education, I think it's going to be, COVID is going to be a game changer. Because now, look at this lecture, right? I was told before that there are 500 people listening to this. We can impart education online almost as well as doing it offline. So our sector is going to see a lot of churn and possibly a rise in productivity. Okay. There's also going to be a large reallocation of labor because COVID is now going to push the online sector stronger. And that reallocation of labor may have higher productivity effects. Labor will now move from low productivity sectors and high productivity sectors because of this rise in job flexibility. There'll also be less travel. We will not travel as much. But we're also going to, again, a challenge, post-pandemic challenges, is that along the supply chain, the safeguards are probably going to raise the marginal costs of production. And therefore, there's probably going to be a structural rise in inflationary pressures, because all along the supply chain, there are going to be safeguards put into place to protect workers, to protect final consumers from. So that may be a new new thing that needs to be watched by the Reserve Bank, by the MPC, is to and this is again nice research to get into. So chase, do a, I don't know what one would call it, maybe a supply chain analysis for the lack of a better phrase, but from the farm gate, if it's an agricultural product, to the final selling or a manufactured product, trace the supply chain and quantify where the price pressures are kicking in. Because if it is coming through some form of the supply chain which is durable, that's going to add to final price pressures later on. But we're going to see higher debt. We'll probably see this. If pressures on the supply chain increase, that's going to lead to higher inflation. Central banks will have to respond by raising their interest rates. For countries in the advanced world, that's a good thing because they're stuck at their zero lower bound, so they want to raise their interest rates. But that's for EMEs, that's going to be a problem because of debt and so on. Also, the pandemic is a demand shock, as I said before, coupled with a supply shock. And therefore, policy needs to respond. But I think the real effectiveness of policy is not so much rate cuts. I mean, rate cuts are important, but it's also liquidity management. Is making sure that, so if you see the new norms that the governor just gave out a couple of days ago or maybe a week ago, now banks who lend to the COVID sector, the medical sector, for instance, can get a 40 bips increment on the reverse repo if they put. So if they lend 100 rupees to the health sector, and if they can get 40 basis points over above the reverse repo if they put money into the reverse repo. So you're going to have it's that kind of liquidity management that is crucial. And I would argue that it's that the bulk of the stimulus is, for us, is because of the lack of fiscal and monetary policy space, should be essentially from a well-targeted fiscal policy that focuses heavily on social insurance, the affected fractions of society, migrants, gig workers, whatever, restaurants, so on, airlines. Liquidity management and monetary policy now has its limits in how far it can go. It can certainly signal accommodative stances, but it's really liquidity and fiscal that is crucial now going forward. And I'll just end. I'll just end by saying that I think one trend that I see healthy in economic policy making in India. There are pluses and minuses. Let me give it a little bit of a positive spin to end. Is that the recent shift towards encouraging the private sector to be an engine of growth is a good one, and that that the view that not only the cost of business in India is high. Everybody knows that, but I think the attempt to do something about it, but also to ease the not only the cost of business, but also the ease of living for people is a thrust, is a pivot that is a good one. There is more infra spending in the pipeline. I worry about the rise in debt. I'm not of the view that our high debt to GDP ratio is okay so long as our interest payments are low. Interest payments, as I said, range from anywhere between 1 to 4% of GDP, depending on whether you take the public account into not or not. And again, the challenge is going to be growth and potential growth. If you say that in India, potential growth was, let's say, about 6% in the 2020s in the last decade, is there room to add to that? And we need careful work on what policies are going to add to that. Is it labor market reforms? Is it agri reforms? And that's where structural reforms are also going to become very, very important. So I'll stop there. Thank you.
Thank you, sir. For me, it was very fruitful. It was like raising the scenario, challenges, issues, and solution, and the future for this pandemic. So now we have some questions from the participants. I'm continuing one by one. Uh, so the first question itself is the monetary policy and fiscal policy mix is essential to counterparts the effects of pandemic.
Sorry, is the monetary policy and fiscal policy mix? Yeah.
Is essential to counterparts the effects of pandemic.
Yeah, all three. Monetary policy should be seen as the interest rate stance, but also the liquidity management side of it. That's crucial. I mean, uh, ensuring that there's adequate liquidity in the financial system. One is systemic liquidity, um, and that also allows, with surplus liquidity transmission to be assisted. But it should be all three. It should be liquidity, it should be fiscal and monetary. But please recognize that fiscal policy space is curbed by coming in a large fiscal deficit, now a large fiscal deficit, the debate about debt interest payments versus debt. Monetary policy space is curbed by projected inflation. When I was on the MPC in the 20 in last year, I think I was the only one warning the RBI that we were going to see elevated inflation. Uh, and across the academic community, the financial market, the refrain was large shock, large disinflation. It didn't happen. Okay, and in my minutes, I think in uh, April or August, I can't remember. I said that there are forces that are raising inflation and there are forces that are keeping inflation down, and the MPC must look at both of those and not assume that the supply side bottlenecks are going to wash away. I mean, the way monetary policy should respond is to say, look, am I observing inflation in lots of items in the consumer price index? If it's broad-based, then there's reason to worry about inflation becoming more entrenched. And so diffusion. Okay? If it's just happening in a few sectors, and for instance, if it's happening because of supply side bottlenecks, or it's happening because of base effects, then that doesn't warrant a change in your monetary policy stance. But if it's right, so the argument made in India was that, oh, these are supply side bottlenecks, the government will work them out, and a truck coming from South India to North India will come at the same pace that it did in the pre-pandemic period. No, it is something to worry about. And it is something to worry about now. And as I said, this kind of supply chain analysis is important to see at what stage of the supply chain do we see these price pressures. It's good research area to be in. But so it's monetary, fiscal, and liquidity management. But also realizing that unlike advanced economies, EMEs have to worry about monetary policy space and fiscal policy space. So it's difficult, challenge.
Sir, additionally, two more questions has been added to the same right way of the explanation. I am just, if you think something that we added, so otherwise we'll be moving for the next question. So the question is, sir, does RBI succeed to boost economy by keeping rate constant or rate cuts in pandemic period? And one more one is, what is the effect of interest rate cuts on savings during this pandemic?
Well,
Should I repeat the question, sir? Or
no. Your interest rate. I mean, there's a broad sense that you don't want to be, moving the interest rate around a lot. You don't want to do 5%, then 2%, then 10%, and 3%. But so there's some inertia in the interest rate, right? Because that enforces the signaling stance and the. But the savings rate is a function of the lack of a welfare state, people's perceived risks to their health, and therefore their desire to raise precautionary savings. And that spiked up to about 20-21% of GDP, and now it's beginning to fall again, and it will begin to spike up again. And that increase in precautionary savings means there's going to be less consumption demand, and therefore that's one way through which the inflationary pressures are going to get dampened. So lower, to answer your question, lower interest rates, all things being the same, that's key. All things being the same, ceteris paribus, will induce households to save less. But what will induce households to save more is the perceived health risks from an ongoing pandemic, which has an uncertain duration. Um, yeah, I think I've answered both.
Okay. So the next question is why outside lags are longer in case of monetary policy as compared to fiscal policy? And can quantitative easing be a correct policy measure to boost domestic demand in this pandemic times?
The lags are not longer. I mean, monetary policy operates with lags, right? Decisions now enacted by the central bank are going to show up in output and inflation readings anywhere between 4 to 6 quarters down the line. So that's what makes the central bank forward-looking. So you have to say that I see pressures on our projections, inflation projections, let's say 18 months down the line, because of reason A, B, C, D, E. So I make a projection, and then in the resolution, we state the upside risks to the projection, right? In other words, what factors are going to make this projection higher? And then if those factors are durable, if they are things that are likely to occur, that would want you to increase the interest rate now to keep inflation at 4% in the future. So it's inflation targeting, but it is more appropriately inflation forecast targeting, because you're setting rates now, keeping in mind risks to the inflation projections made now to keep inflation projections at 4%. Okay, so it's a forward-looking exercise, and it's a forward-looking exercise because households and firms make forward-looking decisions. Okay? So you want to, and then your interest rate decisions now are going to affect output levels and inflation 4 to 6 quarters down the line. So you have to, and the more frictions there are in your economy, informality, banking sector problems, NPAs, shadow banking problems, regulation, forbearance, all of it, the more the less the impact of decisions now on. So the lags will happen everywhere. It happens in the West, happens in emerging market economies, it happens in AEs. You have to quantify those lags when you make these decisions. That's why in the announcement of the framework, you allow the MPC to 3 successive quarters of deviations either below or on top of the band, to because then the governor has to explain to Parliament what he or she is going to corrective steps that are going to be made. But the 9 months is there to give time for the MPC to change its stance, because suppose it sees for 3 months high inflation prints, and then in the 4th month it enacts a hike, then that hike is going to take time to work through the financial system and affect output. So that period is also predicated on the fact that there are lags in the operation of monetary policy.
Sir, one query is there. From where the data should be collected regarding NPA of individual banks and national and international banking sectors?
Yeah, good question. So the Reserve Bank of India has a Department of Banking Supervision, and I have to say I don't know how much of this data is proprietary or not. It's many researchers ask me for it, and I say, look, I'm kind of powerless. So you may be right; it may not be accessible, and then you say, well, okay, I'll go to the annual reports, and you know that in annual reports there's a lot of creative stuff. So what is true there is difficult to understand. But this is a good question. It's a this is a good question. I mean, my simple answer to your question is that you should join the Reserve Bank of India and join the DBS, and then you'll have access to this data. I think. But otherwise, it'll be
Okay, sir.
difficult.
So the next, so the next question is, sir, is there any mechanism to fix interest rate so as to keep balance between external and domestic economy, or does it keep on changing as per policy directives?
The interest rate is set to keep inflation at target, keeping in mind the objective of growth. Um, uh, the Reserve Bank does not, uh, um, right? It only tries to smooth out undue volatility in the exchange rate. Um, in fact, one of the, precursors of effective inflation targeting is a flexible exchange rate. Um, so now in practice, the RBI intervenes in the spot market, or it may intervene in the futures market. There's always intervention, but its stated goal is to not target any particular value of the exchange rate, and let the exchange rate be competitively determined. But and to answer your question a bit more specifically, when should it respond to, let's say, an exchange rate movement? Well, it could be that imported price pressures through some commodities like oil and so on mean that input costs are going to rise and lead to inflation. Then it may be the case that a central bank wants to think about raising the nominal policy rate because of the imported price, the pass through, which is called exchange rate pass through, because of, but the stated goal is to not respond to volatility in the exchange rate, but not target a particular value of the exchange rate, but to smooth out volatility in the exchange rate. So that's what keeps balance between the external and the internal parts of the economy.
Sir, one more question is there. How we explain increase in FDI during COVID times?
Well, some of the sectors like tech and work from home sectors like finance, maybe telecom, India continues to be a growth story in these. There's going to be some rationalization going forward. The economy is going to adjust to these disruptions. And if in these sectors, there are growth prospects, FDI will come in. But remember that now we have an ambitious production-linked incentive scheme. So, and that's driving, production-linked incentive scheme basically says that compared to some last year benchmark, if you add on to it, then you essentially get a production subsidy. And that's quite, that's more than a kind of a tax cut. So it's a sizable impetus. So it was earlier for some sectors, I think textiles, and now it's gone into electronics and manufacturing. And now in South India, for instance, note that we are producing iPhones. Foxconn is here. Wistron is here, if I remember correctly, and another one, 3. And so the electronics sector is getting a heavy push through PLI. So I'm not sure if your question means overall FDI or FDI induced because of production-linked incentive schemes. But again, this is part of the domestic orientation of policy. But it's a subsidy essentially, and therefore it's going to have to be paid for. So some of that rise in FDI could be coming because of this PLI in place.
Sir, one more question is there. How the government interference is seen in PSB in corporate credit influences, and how CBI and CVC harassment to bank official impact bank credit in near future?
It impacts it badly. It leads to a fear psychosis in banks, which affects their credit decisions and increases their reluctance to offtake credit. There's a strong debate in India about what should be the size of public ownership of banks. I like to put it in terms of a soccer analogy. So, if you play against Real Madrid, then they're going to dominate possession. But are they necessarily going to win? It depends on what they do with that possession. Is government ownership of banks above 51% a hindrance? Not necessarily if, corporate governance reforms require minority shareholder rights to have a voice and so on. So it's not, I have a tentative view on this. I'm not sure I'm completely clear on this myself, but I think it's more the raising the regulatory powers of the Reserve Bank of India on the public sector banking space, that because they don't have any powers, right? It's the government that has the powers to regulate PSBs, and I think the Companies Act dictates the powers to regulate the private sector banks. So it's really financial regulation, supervision, whether we should have aggressive asset quality reviews, whether these AQRs should be in the NBFC sector, how do bank boards get appointed, and so on. Look at Yes Bank, right? So Yes Bank was loaning a lot of money, so its assets were huge, and it looked like it was adequately capitalized, but a lot of the loans were given to people that other banks would not give loans to. So you need really kind of, on one hand, you need strong supervision, but it can't be stifling. You have to have a trade-off between allowing credit offtake and adequate supervision.
Sir, if you allow us for 5 minutes, we can continue. 2-3 more questions are there.
Yeah.
In relation to the previous question, one more question is that how you see the IBC and government actions in handling NPA of large corporates?
Well, a lot of the resolution is stuck between IBC, NCLT, and NCLAT in the appellate tribunal. There's also some issue between the some people call it NCLAT or NCLAT, whatever. The disagreement between the NCLAT and the RBI on what to do with the NBFCs. And this came up in the IL&FS crisis. And here, so let me give you one issue. What schedule is it? Is it Schedule 9 or 29 or 27? I can't remember. But it governs the right of a promoter to buy back a company that is under resolution, and and it says you can't, because he gets it back for cheap, right? I mean, but some people argue that, well, why not? You at least, if it was a genuine mistake and there was a shock, and now they can start it and re-employ people, then so there are all these teething issues that and makes a lot of this loan resolution hover between these three entities. So the IBC is a good move. The question is whether it can deal with the quantum of bad loans in the economy at the moment, right? Number one. Number two, whether the institutional structure of it is facilitating a speedy resolution of the bad loan process through issues like this, the schedule, for instance. But you must understand that there's nothing wrong in going bankrupt. Going bankrupt is a good thing. I mean, if it's for a, it's a bad thing because people get laid off and so on. But that's just part of a capitalist economic system, and it's how you deal with the bankrupt entity that is important. So before, banks were not allowed to exit. Now banks are allowed to exit, but there are teething issues. And I imagine that in all countries that have adopted insolvency bankruptcy codes, it always takes a few years to settle down. In India, things always take longer than a few years, as you all know. But I think it's overall a good thing. it's overall a good thing.
Sir, one more question is there. For large markets, India needs the capitalization of lower strata of people, not banks, not debt offered due to political patronage to the corporate friends, and ensuring an end to current farmer crisis.
Yeah, so the corporate banking nexus is an important problem, and that's why there was some pushback recently against allowing large corporates to own banks, because you can immediately see what the conflict of interest is, right? Um, uh, and I think the I talked about financial inclusion and informality. So these are three major silos that the central bank, Reserve Bank, works on. So one is the monetary. It's a full service central bank. Monetary policy formulation, major job. Bank regulation, major job. Financial inclusion, and I think Y.V. Reddy was the first person to frame this back in 2006. If I'm not wrong, I'm not 100% sure. I think seems like this term should have been around before that, but somehow I've read that he's credited with including it. But financial inclusion. Now you ask, why is transmission bad? Go back to the first silo. Well, look at transmission through banks. Look at them through MFIs. Look at them through SAGs, NBFCs. Those interest rate decisions are not reaching all those different entities, right? So that basket is, I think, crucial for financial inclusion. Is important for development first, but it's also crucial for the effectiveness of monetary policy. And you're right, the corporate banker nexus is a problem. On the agricultural issue, I've done some work on it. Please look at my work on the terms of trade and how monetary policy should respond. But I do think that agriculture is in need for structural reforms. It is in need for structural reforms. And that the and this is a priority area. Yeah.
So the last question is, how does government spending affect aggregate demand and supply?
Well, I mean, government spending is roughly center is 10%, states are roughly 5-6%. So government spending is a major component of aggregate demand. So if it goes up, it's going to affect output. And so, but one thing to look at is that a large deficit will creep into core inflation. And so this is also a worry now, is that you've also seen core inflation prints also roughly 5.5%, 5%. It's been sticky, and that's partly because you have large deficits. So, and that's important to watch too, in addition to headline inflation. So government spending can get your economy back to full employment, or if government spending is, but it should be seen as a counter-cyclical measure, not a pro-cyclical measure. In emerging market economies, fiscal policy tends to be pro-cyclical. In advanced economies, it tends to be counter-cyclical. Counter-cyclical means if output falls, G goes up, so you counter it. But here, when you have a boom, the government begins to spend more and so on, and that exacerbates the boom and then kicks in inflation. So policy has to be set counter-cyclically. It should be subject to something like the Fiscal Responsibility Budgetary Management Act, a fiscal rule. Monetary policy should be independent. It should also be subject to a rule-based. So rule-based macro management is important, both on the fiscal side and on the monetary policy side, both through flexible inflation targeting, if that's the framework we have, but also a rule-based fiscal policy, which gives us a guide path to how we want to structure our deficit and debt path, and maybe revenue deficit as well. Because that is important for also sovereign raters and so on, and it affects the debt premium and interest rate premium and so on, and cost of capital abroad. So all those things are important when you set G.
Sir, one participant has requested to share articles and notes related to this lecture or yours. So
Yeah,
if
I have stuff written down here. I don't have anything typed up. Uh, Presumably that this is out there on YouTube, so you can listen to it. But I would like you to. I don't just want this to be a talk on policy. I want this to be a research talk as well. I want you to look at some of the stuff. Hopefully, you will on informality, monetary policy, and then also terms of trade monetary policy. There was a question on agriculture. I think distortions in the agricultural sector, thinking about food inflation from a more granular structure, multi-sector structure, where we pick up on distortions in the agricultural sector and formally model them, is an exciting way to do monetary research. We should contribute to this research agenda uh, by through these areas collectively, all of us, and this is where Indian macro can contribute. I worry a lot about how strong Indian macro is on a research side. It needs more modern work, more training, more hard research, more of you to attend international conferences, more people do top work in macro, and I hope that that all of you will, and will put Indian macro on a higher pedestal. That's my mission in life. So, and I hope that's also your mission, or will be your mission.
Sir, we have seen already in your bio that you usually your additional co-curricular activities like jazz guitar playing and running in his spare times. It is really a versatile type of personality, and I'm sure that the participants who are attending or listening the lecture, surely they are imbibed to think differently about the economy which is suffered by the COVID, and what the injections, what vaccination should be required to solve these issues of the economy. So thank you very much, sir, for delivering such a wonderful lecture and benefiting us and enlighten us with the knowledge of these monetary strategies and raising the issues, retreat of globalization, asset liabilities, NBFCs, and its relevance, engines of growth, diversity, wise data focused companies, vanilla recession, long the effect of pandemic in highly unequal. Lot of issues you have raised which we all must think about if we want to do some research work or academic work in this area. So we are very much thankful on behalf of organizing team, whole organizing team and college, sir. Thank you very much for delivering us such a wonderful lecture, and we wish you a good health and safer days ahead, and thank you for giving us time, sir. Thank you very much, sir.
Thank you, and I wish all of you well too. Please stay safe, and all the best to you. Thank you. Thank you.
Thank you very much, sir.
Thank you.
Thank you, sir. Stay safe.
Thank you.
Ravinder, sir. Ravinder, sir, is the live stopped? Is the live stopped? सोनू सर
लाइव है सर अभी भी, और कॉल करना होगा उनको.